Hi class, today's lesson will be Chapter 2, Problem 2, 3B. So if you'll hold on just a minute, I'm going to share my screen with you. You should be able to see Problem 2-03B now. And what we're going to be doing today is we're going to be learning about a journal and a ledger. A journal is the first official place where we record transactions. I know in the last video we learned how to put our transactions into T accounts, which are tools that will help us to analyze transactions. You also probably should be doing the T accounts for this to help you to analyze transactions first. But as we said before, the T accounts are not formal accounting documents. They're just tools that help us to analyze the transactions. So they're kind of like the scrap paper that you would use before you actually write into the first formal book in accounting, which is called the journal. The journal is a actual book that looks something similar to this. It's got a page on the books that has printed on each page what a form would look like for a journal. And on each journal page, there will be a place where you can record the date. Dates are very important in accounting. They let us know which accounting period that we're working in. They'll have a column for a date. They'll have a column for a description. In the description, you're going to put down the account titles. The account titles would be like, if you were analyzing a transaction where you were buying supplies with cash, your cash account would be affected, and so would your supplies account. These accounts will go under the description column. There's also a post-reference column, which just serves as an audit trail. In earlier days, when we were recording transactions in journals and not using computers to do it, we put everything in the journal first, and then we would copy to a second set of books that we call a ledger. And the ledger looks like this. It's actually a book, but on each page of the ledger we'll have the name of the account. We'll have an account number that will go with that. This account number is what we're going to use as a post-reference in our journal. So we cross-reference books. There are two sets of books that we'll be keeping, a journal and a ledger. When we write in the journal first, then we copy the amounts to the ledger. Once we put them in the ledger and copy them to the ledger, it's a process that we call posting. We'll pick up the account number and put it back in the post reference. So there's a specific way that you record journal entries. You might also notice on the journal, the first book of original transactions, that we have a place to record debits and we have a place to record credits. What I would say to you is that you should analyze each one of the transactions on your own scrap paper first in T accounts, then copy from the T accounts into the journal. In the journal, we always put on the first line our debits. Debits go first, and then we will indent and we will place our credits next. So let me show you an example of how to do that. On October the 1st, Jay transferred cash from a personal bank account to an account to be used for the business, $18,000. So since this is a brand new business, because on October 1st, Jay Pryor established an interior decorating business He's just starting the business. There's no previous owner's equity or no assets or liabilities that they had prior to this time. We're starting a brand new business. So the owner's putting money into the business. You'll remember we would draw a T account for cash. We would enter the amount that the owner has deposited in that T account, which would be $18,000. In the T account for cash, since it's an asset, it's going up on the left side, which is the debit side. So when you put it in the T account, you're putting it on the debit side. Then you're going to copy from the T account to your journal, and we would put on the first line, our cash account was debited for $18,000. Notice that I skipped the post reference. You don't put the post reference in until you've copied this amount to the ledger. So what we're going to do first is we're going to put everything in the journal first, and that's what I would suggest that you do. The first transaction, we've got our first debit to the cash account. Every transaction has to have at least two parts to it, so we know we've got another part to it. And if we're looking at October 1st, you can see that the owner made a personal investment that was to be used in the business. This investment is what we call capital. So we're going to look for J. Pryor Capital in our drop-down list. We're going to click on it, and then we're going to go all the way over to the credit side, and we're going to write in 18,000. This is what we call a journal entry. When we record a debit, it goes first, and then we indent. You see how this is indented here? And then we'll record our capital in the credit side. This is an example of a journal entry that happened on October the 1st. So you would analyze your transactions through your T accounts on your scrap paper and then copy them into the journal. Always put your debits first in the journal. It really doesn't matter on the T accounts because you're just analyzing on the T accounts. But you have to put your debit first in the journal. Skip over this post reference for the time being. When we get through with the journal entries, then we'll go back and we will post to that ledger account. So on October the 4th, we have paid rent for the period of October the 4th to the end of the month, and it was $3,000. What has happened here is we paid for 1 month's rent. Our cash is decreasing by $3,000. To decrease cash, which is an asset, you would credit. Our rent expense, however, is increasing. To increase rent expense, we would debit that. So from our drop-down list, always record your debits first. We're going to have a debit to rent expense for the amount of the rent that we paid, and they paid $3,000. So I'm going to write that in the debit column. Notice this is in the debit column because my rent expense is increasing. It's going up. To increase an expense, you would debit. In my second line of the October 4th transaction, I would record cash. I spent my cash, so my cash, which is an asset, is going to go down. To make our assets go down, we record it on the credit side. Again, I've created a journal entry to show that we have paid rent expense for this month. We're going to move to the October 10th transaction. We purchased a used truck for $23,750. We paid $37.50 down, and we gave a note payable for the remainder. This is an example of where we have more than two accounts involved. First of all, you have purchased a used truck. So our assets truck has increased by $23,750. to increase an asset, we would debit. So I'm going to go down here, and on October the 10th, I'm going to record that I bought a truck. So my truck account has increased by the amount that that truck cost us. It cost us $23,750. So I'm going to put that as my debit. Then you're going to look at the second part of this, which says that they paid $37.50 down. This is a down payment toward the truck. So this $37.50, we have paid out in cash. So our cash is affected. We're going to go all the way over to the credit side, and we're going to record that our cash has decreased. It has decreased in the amount of $37.50. So we're going to credit cash for $37.50. Because our cash, which is an asset, has decreased, you put it on the credit side. Notice this transaction is not balanced. Our total debits do not equal our total credits. So we have yet another credit that we're going to have to put down to make it balance out. And so what we're looking at here is we paid down $37.50 out of the $23,000 total purchase price. We paid $37.50 toward that. If you subtract $37.50 from $23,750, it will leave you with $20,000. You might notice that when I get this entered in, I got to put down that it was a note payable too. Sorry. The notes payable is going to be credited because we owe more now than we did before. You see, it says that you gave a note payable for the remainder. The remainder is $37.50 from $23,750 is $20,000. So we needed $20,000 to balance out this entry. Notice that our total debits here have to equal our total credits. These two added together equal this debit. Our debits and our credits must equal in every transaction. So this was an example of what we call a compound entry because it has more than two parts associated with it, but the transaction has to balance out. On October the 13th, we purchased equipment on account for $10,500. Since we bought equipment, we're going to record equipment as our asset account. Assets are increasing. To increase equipment, we will put it on the debit side for the cost of that equipment. The cost of the equipment was $10,500. That $10,500 has to go in the debit column because our equipment has increased. To increase an asset, you debit. Because we did not pay cash for that equipment, we put it on credit, our accounts payable will be increasing. Accounts payable is the liability account, and it's $10,500. Notice in our drop-down list here, we could have chosen notes payable if the transaction had said that we signed a note. There's a difference between notes payable and accounts payable. Notes payable carries interest with it. So if we have to pay back interest on this equipment that we purchased, it would be a note that we would have recorded. And in our transaction, they would have told us that there was a note. In this case, they did not, so I chose accounts payable, and that's the correct amount that you would use for the October 13th transaction. If you look at October 14th, you can see that they purchased supplies for cash. We bought an asset. My asset is supplies. That's really a prepaid expense, but we call it an asset when we buy it because we have the rights to use those supplies now. The supplies account, which is an asset, is increasing because we just purchased some supplies for $2,100. So we're going to debit the supplies account for $2,100. We also know from this that we paid cash, purchase supplies for cash. Anytime we pay out cash, our cash is decreasing. So our cash account would be credited for $2,100. Cash, which is an asset, is going down. Notice supplies as an asset is going up, but cash, which is an asset, is going down. So the total of our assets would not change overall, but we just exchanged one asset for another. It can affect only one side of the accounting equation. So right here's an example of where assets have gone up. With the supplies, they went up, cash went down. So the total assets was unaffected, but there was an exchange of one asset for the other, kind of washed each other out, in other words. On October the 15th, we paid an annual premium on property and casualty insurance for $3,600. When we buy insurance, we have to record it as a prepaid account. It's a prepaid expense, so it's an asset to start with. So we're buying prepaid insurance. The amount that we paid for that prepaid insurance is the cost of the insurance. The cost of the insurance is $3,600. So we're going to put it on the debit side. Now remember that prepaid insurance is an asset. Our assets are increasing because we bought some insurance. We didn't have any insurance yesterday, but we now have it today. So we have some insurance that we can use. Since we bought the insurance, our asset went up. To make the asset go up, we would debit. It also told us that we paid for that. So we paid cash of $3,600. Our cash account is decreasing in this case. So we're going to record it in the cash account for $3,600. And since cash is an asset and our cash is going down, we have to credit it. On the second 15th, we received cash this time. So our cash is increasing. Cash, which is an asset, is going up by the amount that we've received. We've received $89.50. Cash is debited for $89.50. Then you need to look at your transaction to see why you received the cash. And it tells you that you received it for a job that's completed. A job completed is revenue. Revenue increases on the credit side. Anytime we work, our revenue is going up. So we completed a job, it makes our revenue account go up. We need to know what the revenue account is, because sometimes it can have different names associated with it. But the best one out of this list is fees earned. Fees earned is our revenue account. Revenue is increasing. To increase revenue, we credit it. So this is one page of the journal. And we've recorded our journal entries, a process that we call journalizing the transactions. Notice I left everything blank in my post reference. I'm going to come back to that once I'm finished posting all my transactions to the journal, when I copy from the journal to the ledger, I will put in a post reference here. And I'll talk to you more about that in just a minute. Notice they put those journal entries on one page. They're emphasizing to you that the journal is a book. It has pages on it. Notice the pages are numbered. So this was page number 1. We're going to go to page number 2 and complete the rest of our journals. Imagine it being a notebook and you switch pages here. It's still the journal. It's still the book that you're recording in. The journal is a book of original transactions. We're going to record the transactions in the journal first. It's the first place where we actually formally record transactions. On the 21st, it says we paid a creditor a portion of the amount owed for the equipment that was purchased on October the 13th. We paid $2,000 to the creditor. So my accounts payable will be decreasing in this situation. To decrease a liability, we would debit. So accounts payable is going to be debited for the amount that we paid out, which was $2,000. To decrease a liability, we debit the liability account. We paid cash to that creditor, so our cash, which is an asset account, is decreasing. To decrease an asset, you would credit. On the 24th, we recorded jobs completed on account, and we sent invoices to our customers for $14,150. What you're doing is you've completed some jobs and you sent invoices. So when you see that you have sent the invoice to a customer, that means that we are creating an account receivable. We don't have the money for that revenue that we've worked for yet. So accounts receivable is an asset account. My asset account is going up. It's going up for the amount that I have sent invoices for, which is $14,150. And what gave me the right to send an invoice to a customer was that I performed some revenue. So my revenue account, fees earned, is increasing. To increase revenue, you will credit it. Revenue's going up, your assets are going up. The left side of the accounting equation is $14,150 as an increase. The right side under owner's equity is increasing our owner's equity by $14,150. The revenue adds to the owner's equity. Now look what happened on the 26th. This time we received an invoice. If we're receiving an invoice, that means that we're going to have to pay something in the future. That means that we owe an amount in the future. We've received an invoice for truck expenses. It is to be paid in November. This is October that we're recording the transactions on. On October the 26th, we received this bill. It is an expense in this month. So we're going to record it as the truck expense. And the amount of that expense was $700. So I'm going to debit my expenses because expenses increase on the debit side for $700. and I'm going to credit my accounts payable because I'm not going to pay that $700. It's not due until November. So I've created a liability account to go with that expense account there. I owe $700 for this that I'm going to pay next month when the invoice is due. On the 27th, we paid utilities expense of $22.40. Anytime you pay out your money, your cash is decreasing. Anytime you record an expense, the expenses are going up. Especially in this chapter, expenses are always increasing in this chapter. In a later chapter, we'll show you that expenses can go down, but when we incur an expense, such as paying a miscellaneous expense, our miscellaneous expense is increasing. So let me make sure I pick up the right account here. It's miscellaneous expense for October. No, I'm sorry, it's not. Let me go back to October 27th. It told me really right here that this is utilities expense. But you have to read it, read your transaction. So go back to October 27th, and it's the first one. You paid utilities expense of $22.40. The amount of that expense was $22.40. And because it's an expense, we have to debit it to increase it. Expenses are always going up in this chapter, so expenses are going to be debited. What I'm going to credit here is my cash, because cash is an asset, it's going down. To make our cash go down, we would credit it. On the second October 27th entry, it says that we paid miscellaneous expense this time of $1,100. So this time it is a debit to miscellaneous expense for $1,100 because our expenses are increasing. On the debit side, we'll credit our cash. Our cash is an asset and it's decreasing on the credit side. So on October the 29th, we received cash from our customers on account. Receive cash. Cash is increasing. So to increase cash, we would have to debit it. Cash is an asset. We're going to increase it by the amount that we have received. We received $7,600 worth. And then we're going to credit, read your transaction. It says that you receive cash from customers on account. Customers on account can only signal that it's an account receivable. Your accounts receivable, which is an asset account, is going down. So accounts receivable, which is an asset, is decreasing. To decrease an asset, you would credit. And then on October the 30th, we paid wages to employees of $4,800. We're going to debit our wages expense because our expenses have increased by $4,800. And then we're going to credit our cash for the amount of those salaries. Our cash went down by $4,800. To make a cash go down, which is an asset, it goes on the credit side. And the last one, we withdrew cash for personal use. Anytime there's a withdrawal, we're going to use the withdrawal account or the drawing account. So let's choose the drawing account because there was no withdrawal showing on there. The drawing account, drawing, like expenses, increases on the debit side. So anytime you have drawing, you're going to increase it on the debit side for $3,500. Like expenses, drawing will never decrease unless you're in the closing process, which will come in chapter 4. So right now, expenses are always going up, drawing is always going up, your revenue accounts are always going up, and they will never go down unless you're in the closing process. They're always increasing. My cash is going down in this situation because my cash is decreasing. To decrease an asset, you would credit. Now, once you get everything written into the journal through the process that we call journalizing, check your work. You want to make sure that all of your journal entries are correct at this point in time. If they're not, fix them, because you cannot go on from the journal and post to the ledger correctly if you've got a journal entry wrong. So the first place that you're officially going to record journal entries, the first book, is the journal. And then if you can imagine, we've written everything in a journal, in our notebook in a journal. Now we're going to copy this information that we've written in the journal to the ledger through a process that we call posting. Posting just means that we're going to take the information from the journal and put it into the ledger. We're going to start with the first transaction, which was October 1st. We're going to start with the debit to our cash account. We had to have some cash to operate this business with. We debited it for $18,000 because the owner made an investment. So on October the 1st, we will go to the cash account, which is located in the ledger. We will put down our post reference first. In the post reference, we're going to put the page number of the journal that we're copying this information from. The post reference, so it shows an audit trail. So this cash came from page number 1. So in my ledger, where it says post reference, I'm going to put a 1 here, because the cash was debited in this transaction on October the 1st. I'm going to put a debit of $18,000 into my cash account. I've copied from the journal, page number 1, the debit to the cash account, which we're working in. I did not credit it in this transaction because $18,000 debited increases my cash account. I now have a balance in my cash account that is a debit balance of $18,000. When I copy from my journal to my ledger, it's a process that we call posting. You are not through with the posting process until you pick up the account number and place it in the journal. We're going to put it in the post reference here. The account number for cash is 11. We have posted this to the ledger. When we put this in the journal, we are showing that we are through posting. We're through posting this part of October 1st. We're not through posting, but we're through posting this part of the transaction on October the 1st. The second part of the transaction, notice, is capital. And we have credited the capital account. And this came from page number 1. So we're going to copy into our ledger account called capital this time. So down in your ledger, you're going to scroll until you see the account title, capital. And here's my capital account. For the post reference, I'm going to put journal page 1 because we were on journal page 1 that I'm copying from. I'm going to skip my debit this time. I'm going to go straight to my credit and I'm going to put in 18,000. Why did I put a credit in there? Because when I recorded it in my journal, it was credited here. So I'm going to copy that into my ledger in the capital account. The balance in the capital account is 18,000 and it has to show as a credit. Remember, the balance side is on the increase side of the account. Capital increases on the credit side. So the balance will be on the credit side. The balance in the capital account as of October 1st is 18,000. The owner's equity is right now 18,000. That's what the owner's worth. Pick up your account number, which is 31, and we're going to place it into the journal to show that we are through posting our accounts. So then we're going to go to rent expense. Rent expense is debited. I'm going to copy to the rent expense account in my ledger the debit. So I'm going to find rent expense. I'm going to put in, it comes from page 1. The debit amount was $3,000. Rent expense was debited. See how it's on the debit side here? I copied it as a debit, and my cash is going to be credited. But before I do that, I got to finish up my rent expense. So let me go back to rent expense. I've got to put a balance in the rent expense account. Since rent expense increases on the debit side, its normal balance is going to be on the debit side. These last two debits and credits are for the balances. In this case, rent expense always should have a debit balance because that's the side it increased on. Notice you debited it here, so you're debiting it here. The amount or the account is 53, and you put it here, and then you're through with the posting process for rent expense on this transaction. Move to your cash account. Now, I want you to see what happens with the cash account. We've got cash credited on October the 4th, so we reduce the cash account. We go back to the cash account on October the 4th. We write down, we got this from journal page 1, but we go to the credit side because on journal page 1, our credit was to the cash account right here for $3,000. Anytime you credit cash, which is an asset, you're reducing the cash account. So the new balance, the old balance was 18,000. When we reduce the cash by 3,000, we bring this down to 15,000. Notice I put it on the debit side. The cash account, which is an asset account, should always have debit balances. So all of these should be debit balances. If you ever have a credit balance in your cash account, you've overdrawn your cash account. And so you know that something's wrong. You better go put some more money in, or you better check your information. You didn't write it down right. So 18,000 was a plus because cash is debited on cash increases on the debit side. When we decrease the cash on the credit side, it makes the cash go down. So the new balance at October 4th in the cash account is $15,000. Pick up the 1-1 and put it in your journal, and you're through posting the October 4th transaction. Then we're going to look for truck, and we're going to go and see what truck we're going to put. We're going to put a amount in of $23,750 as a debit to the truck account in the ledger. So go to your ledger and look for your truck account. Here's my truck account. My post reference is journal page 1 because that's where I'm getting it from. I'm going to debit my truck amount for $23,750. The balance in the truck account now is $23,750. I pick up the account number 18, and I put it into the post reference. I'm going to credit my cash now for $37.50. So I'm going to look for my cash. I'm going to put in, it came from page number 1. I am crediting it this time for $37.50, and I've got to balance my account. So the previous balance was $15,000. That's the previous balance right there. I'm going to subtract $37.50 from it, and what I have left over is $11,250. Pick up your 1-1. I'm going to put it right here. And then I've got another credit for $20,000 to my notes payable. I'm going to look for notes payable. Notes payable, the post reference comes from journal page 1. I have a credit to my notes payable of $20,000. That's what I copied from my journal above, because notes payable is a liability. It increases on the credit side. So the credit side will be the normal balance of the liability. You have to be careful and get it in the right side for the balance. Liabilities increase on the credit side, so they should have normal balances on the credit side. Pick up the 2-1 and copy it here. Then we're going to move to equipment. We bought equipment for $10,500, so our equipment was increasing. We got it from journal page 1. The equipment increased by the amount of $10,500. I'm just copying it from the journal into the debit column, because equipment is an asset. Assets increase on the debit side. Its balance should be on the debit side. Pick up the 1-6. And it goes into the equipment account, or in the general journal for equipment is 1-6. This 1-6 tells an auditor, hey, if I look for this transaction, it ought to be in account number 1-6 in the ledger. These post references serve as a cross reference between your journal and your ledger. accounts payable is credited for $10,500. So I'm going to go to my accounts payable. Post reference is 1. On the credit side, I'm going to put in the amount of my accounts payable, which was $10,500. Your accounts payable is copied from the credit in the journal. Accounts payable is a liability. It increases on the credit side. So you have to put it on the credit side for the balance. Again, this is a debit, this is a credit. They stand for the balance columns. Accounts payable will always have a credit balance. If it doesn't, something's wrong with it. Pick up 22 or 22. Put that in there, and you're through posting that transaction. I'm going to move to the next one where we've got supplies debited at $2,100. Post reference is journal page 1. I debited it for $2,100. My supplies is an asset. Assets go up on the debit side, so the balance should be $2,100 right now. And then you're going to pick up, I'm sorry, I'm moving too fast here. Pick up 13 and put it here. And so if you have to take a break, you have to go somewhere, you have to do something, you'll know where you posted to if you do this process. Now, a lot of times I see students just putting in the numbers. They don't do it in a particular order, but technically you will be lost. If you had to get up, or it was Friday afternoon at 5 o'clock and you want to go home, you want to pick up with this on Monday, then you'll know where to come back to. So we're going to start with cash here at $2,100 as a credit. And previously we had cash of $11,250. I'm going to subtract from that $2,100. Our balance down the cash account is $9,150. It should always have a debit balance, cash should have. So right now we've got $9,150 left to spend. Put your account number, which is 11, and you're through posting this transaction. Moving to the next one, prepaid insurance is debited for $3,600. Journal page 1 goes in the post reference. $3,600 is our debit. Because prepaid insurance is an asset account, it's going to have a debit balance of $3,600. And we're going to pick up the account number 14 and put it in our journal. Our cash account is credited for $3,600. Journal page 1, $3,600. And we'll subtract $3,600 from the $9,150. And that leaves you with $5,550. And you'll pick up the 11. And you'll put it there, and then we'll move to the next one. On the next one, we're debiting cash this time for $89.50. Still comes from journal page 1, but this time it was debited, $89.50. When we debit cash, we add to the previous balance. So I'm going to add $89.50 to that balance. And that's going to give me $14,500. And then I'm going to pick up the 1-1 and I'm going to put it here. And then fees earned is going to be credited for $89.50. And this came from journal page 1. We credit it for $89.50. And fees earned, which is revenue, always has to have a credit balance. The credit balance in fees earned is the increase side of the revenue account. So 41 is the number on revenue. And we put it in here. Notice we're through posting to our journal on the first page. We're going to go to the next page and we're going to pick up accounts payable. Notice we're on page 2 here. So when we go to accounts payable, in the post reference now, it's changed to page 2. So accounts payable right here, we're going to put a page 2 here. And what happened in page 2 to our accounts payable was we had a debit for $2,000, which means we have reduced our liability account, accounts payable, by $2,000. We debited it in our journal, so it's going to decrease our balance that we owe by $2,000, which would leave you with the balance that you still owe at $8,500. Put in 22 in the post reference, and you just keep right on going. Cash is credited for $2,000. Came from page 2 this time. It's credited for $2,000. So we've reduced our cash to $12,500. Pick up your 1-1, put it here, and then we move to accounts receivable. Accounts receivable is $14,150. It came from page 2. It was a debit, $14,150. We're going to debit that account for $14,150. Why is it a debit? Because it's an asset. Assets increase on the debit side. So accounts receivable is an asset. Pick up your 1-2. Put it here. For your fees earned, we're going to credit it for $14,150. So I'm going to look in my ledger for fees earned. I'm going to put the page number down this time of 2. It is credited for $14,250. And what I have to do is I have to add the $89.50 that I had previously as a credit, plus what happened this time, $14,250. And that will give you $23,200. Okay, I put $14,250 in my fees earned. And it was $14,150. So I better go back. Let me check my accounts receivable too, just in case I wrote down the wrong thing. So I'm going to go back and look to see, because I think I got an error here. $14,150 in my accounts receivable. I put it down right. I just didn't put the revenue down right. This should be $150. So $89.50 plus $14,150 is a balance now at 23,100. Let me change that balance. And that should be right. We'll find out in a minute when we check our work, but I'm going to move on. So I hope we don't run out of time again. If we do, I'll just have to make you another video of wherever we've left off. So right now, I think everything's okay. Truck expense is debited for $700. So I'm going to go to my truck expense. Post reference is page 2 in the journal. And I'm going to debit this account for $700. So it's going to have a debit balance because expenses increase on the debit side. Its balance should be on the debit side. Pick up 55. And put it on your journal. And then we're going to move to accounts payable at 700. And our accounts payable at 700 was credited. So move to accounts payable, and we'll put a credit of 700 here. And I'm going to take the previous balance of 8,500. I'm going to add to it 700. And I got a new balance at 9,200. Pick up your 22. Put it here. Then we're going to move to utilities expense. We're going to put in the debit to the utilities expense, which was $22.40. I'm going to have a debit balance of $22.40 because expenses increase on the debit side. 54. It's going to go right here. And then my cash is going to be credited for $22.40. Cash is going down. So its previous balance was $12,500. I'm going to subtract $22.40 from that. And that's going to give me $10,260 is my new balance in the cash account. Put your 11 here. And I'm going to move to my next account, which is miscellaneous expense. Miscellaneous expense was debited for $1,100. Came from page 2. It's debited for $1,100. Expenses have debit balances. 59 is going to go, or 59 is going to go here. And then we got a credit to cash for $1,100. I'm going to subtract $1,100 from the previous balance. Now we have cash at $91.60. Now I have a debit to cash of $7,600. And since it's a debit, I got to add it to my previous balance. My new balance is $16,760. And then I'm going to move to my accounts receivable, and I'm going to credit that for $7,600. And then I'm going to subtract, because when you credit accounts receivable, you're crediting an asset, you're reducing the balance. So 14,150 minus 7,600 leaves you with a balance in the accounts receivable as a debit balance, because accounts receivable is an asset. Its balance should be on the debit side, and you're going to post it to $12. And then we're going to move to wages expense. And wages expense went up by $4,800. It's an expense, so it should have a debit balance. The balance is on the side of the increase. Then the cash is credited for $4,800. When we credit cash, we're reducing our cash. Our previous balance was $16,760. We're going to subtract $4,800 from that. And that'll leave us with $11,960. And then our drawing account increased by $3,500. Since drawing is a drawing account, drawing increases on the debit side. $3,500 is going to be the balance in the drawing. Then your cash account will be credited for $3,500. We have a remaining debit balance of $8,460 left in our cash account. So the process of copying from the journal to the ledger is what we call posting. We have posted to our ledger accounts. It's a really good idea to check your work. We want to make sure everything is okay at this point in time. All right, so the next step is to take just the ending balances and put it on the trial balance. The trial balance is a tool that just shows us that we've entered information in as best as we know how to do. If it balances out, that's a good thing. If it doesn't, we're going to have to go back and look for our mistakes. So start with your first ledger account, which will always be cash. Cash has a balance of $84.60. Cash had a debit balance of $84.60. I just copied that from my ledger account. Once I'm through with my cash, copying it in there, then I'm going to move to my accounts receivable account. That's the next one. Accounts receivable has a balance of $65.50. Accounts receivable is an asset account. It has to have a debit balance here. Our next account after accounts receivable is supplies. It has a debit balance of $2,100. You're just copying the ending balance. Supplies at $2,100. The next account is prepaid insurance. It has a balance of $3,600. Prepaid insurance is an asset. It's got a debit balance of $3,600. You're just copying it down. The next account is equipment. It has a balance of $10,500. Copy the ending balances only. Equipment has a debit balance because it's an asset account. Your next account is truck. It has a debit balance of $23,750. Truck has an asset account. It will have a debit balance. Our next account is notes payable. It has a balance, a credit balance of $20,000. Be careful here. Notes payable, credit balance of $20,000. Look for your next account, which is accounts payable. It has a credit balance of $9,200. The next account is capital. Capital has a credit balance of $18,000. Then your next account is drawing. Drawing has a debit balance of $3,500. Your next account is fees earned. It has a credit balance of $23,100. Your next account is wages expense. It has a debit balance of $4,800. Your next account is rent expense, which has a balance of $3,000. Has a debit balance of $3,000. Your next account is utilities expense, has a debit balance of $2,240. And your next account is truck expense for $700. Your next account is miscellaneous expense at $1,100. Okay, it might be a good idea to check your work now. And it looks like we've written everything down right, so that's good. You need to total your debits and total your credits. I'm going to total my credits because it's a shorter column. These two plus 18,000 plus 23,000 equals 7,300. And since I know that all of these are written down right, this has to be 70,300 too if I've added my credits correctly. And I did. So my trial balance balances, and for all we know, we've written down everything as we have it. It doesn't mean that we're exactly right because we could have left out a transaction. And then in the next step, they say, determine the excess of revenues over expenses. So our revenue account is $23,100. We're going to subtract from this revenue all of the expenses. Wages expense was $4,800. Rent expense was $3,000. Utilities expense was $2,240. 700 was your truck expense, and miscellaneous was 1,100. What's left over, if I've subtracted right, is 11,260, which will be your net income. All right. And then in 5, it says, can you think of any reason why the amount determined in 4, the net income, might not be net income for October? And then they give you a choice. Over there. And the best answer for this is number 3, because some of the supplies may have been used during October, but no supplies expense has been recorded. And If you don't get that, don't worry too much about it. What's important for you in this chapter is to know how to journalize correctly. Put it in the general journal. Then we copy from the general journal to the ledger. You need to know how to post to the ledger. This is so important. And then from the ledger, you copy into the trial balance. These are the first formal steps of the accounting cycle. Journalize your entries, post them to the ledger, prepare an unadjusted trial balance. In the next chapter, we'll be adding to this. So learn how to journalize, learn how to post and balance your accounts in your ledger, and learn how to do an unadjusted trial balance. Those are the most important things that you can learn in this chapter. And I'm going to stop sharing now, and I'm going to stop the recording. So we'll see you next time. Bye-bye.